Okay, well, we'll get started and more will join us as we go. This is always a full session for a half hour, so we want to get moving on that now. So I just want to welcome everyone to another Financial Friday with Sainies and Equitable. Today's topic is life insurance awareness. Sainies is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Equitable has a longstanding presence in New York, and a large portion of the New York client base is built upon the work they do within the public education system. Through Equitable, Sainies members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Sainies members, which we urge you to take advantage of. This is a great benefit of membership. Joining us today from Equitable is Greg Ronenberger, a regional vice president with Equitable based out of Syracuse. So we'll save questions until the end of the presentation, but feel free to add your questions in the Q&A panel at any time. Our Q&A time today is best used for general questions, but know that Equitable team is available at any time to answer your personal and confidential questions. And you'll find Greg and the other regional Equitable representatives' contact information at sainies.org. So now I'll turn it over to Greg. Greg?
Thank you very much, Michelle, and thanks for joining us, everyone. And September is Life Insurance Awareness Month. So we spend a lot of time talking about this just as an opportunity to help folks and to educate folks. But specifically in September, when there's a lot going on, we know in your world, certainly a very busy month, but we do want to take some time just to look at the benefits here and some of the information on insurance, because it is very important. Speaking as someone who has been in this business for a little over 20 years now, I've seen a lot of people pass away, unfortunately, seen some very positive stories with people that have taken the steps to protect themselves and their loved ones, and have seen some people ignore that and certainly have seen the negative impact of not having insurance coverage. So what we want to do is just educate you folks on a few different areas in the life insurance world, just talk about the importance of it and why we should be having these conversations with our families. So of course, disclosure comes first. Know that this information is meant to be general in nature, and if anyone needs any specific information or advice, we do recommend you consult your financial professional for that. So some things that we'll talk about today: the types of life insurance that are out there, how do we determine what we need? You could see how we do it here at Equitable. That could help. Talking about some different areas of opportunities in the planning aspect that life insurance could help with. So we say there are actually some living benefits to life insurance. It's not all about doom and gloom. And then what we need to do from a next steps standpoint. So when we look at the basics of life insurance, this is a little something that we call a life insurance 101. So just an introductory into the different types of life insurance. And effectively, there are two different types of insurance, what we call term and permanent insurance. Term insurance is temporary coverage. It's designed to help us cover a need for a specific period of time. So for example, we might have young children in the home and we want to have a 20-year term plan to cover ourselves until they leave the home after they graduate college, which I know a lot of times that time frame extends out a little past that 20-year time frame. Or maybe we take on a loan for 10 or 15 years and we just want to cover that loan. So the term insurance will last for that specified time period. Just from an example standpoint, and these are just numbers to create an example, it's not specific to any certain situation. Let's say there's a $500,000 death benefit. Inside of a term insurance plan, there's a cost of insurance, and that cost of insurance, let's say, is $100 per month. Well, the premium that we pay the insurance company to provide that benefit to us is $100 per month. So we're effectively paying to cover the cost of insurance. So term insurance tends to be a very cost-effective type of plan where we could get a large amount of coverage for a relatively inexpensive premium. Now, when we look at that benefit of $500,000 and we say, well, what is the probability that the term insurance plan will pay that death benefit to beneficiaries? It's typically pretty low. So we could look at that in a good way, in that if I have a 15-year term policy and it doesn't actually pay a death benefit to my beneficiaries, that means I lived past the 15 years. So I'll take that as a good sign. But some people don't like the fact that it is only temporary type coverage, and that only about 2 to 3% of term insurance plans actually pay a benefit out to beneficiaries. So there are some people who desire a more permanent solution, and there is permanent life insurance to cover that individual's needs. So if we look at that same $500,000 death benefit, because it is a permanent solution, it will pay out 100% of the time because we're going to cover that individual for as long as they live. Now, because it is a longer time frame that the insurance is enforced, the cost of insurance is going to be a little bit higher. So let's say in this hypothetical, totally fake example, it's $150 per month for that cost of insurance, but a premium we pay is going to be more. It's going to be $300 per month. Now, we look at, okay, there's a difference there. We're covering the cost of insurance plus extra. Well, why is that in a permanent plan? And remember earlier I said there are some living benefits to life insurance. This is one of them, where if you look at term like renting something, permanent is more like owning. So what happens when we own something? We build equity. When we own a home, we build equity inside that home. Well, it's similar to these permanent life insurance plans, where that extra $150 a month goes into what we call a cash account or an equity account inside the plan. And that equity account will actually grow. We're able to earn interest or growth on the plans depending upon the type of plan that we have. Some of us may be familiar with whole life or universal life insurance. Many times our parents bought us a small $5,000 or $10,000 whole life policy back when we were younger, and maybe some of us still have those plans. I got one, my parents handed over to me and finally said, here, you pay this. We don't want to pay it anymore. It's a small benefit, but I keep it just because, why not? My parents bought it. It's $60 a year. It's not that expensive. But that cash value inside the plan grows based on interest rates. The insurance company takes that money, that equity, they invest it, and they credit me an interest rate somewhere typically between 2 and 4%. So that works for people who are a little more conservative in nature, don't want to see a lot of variation in their growth. Others like to see variation in their growth. They say, well, gee, the insurance company is investing that money and they're only crediting me a small portion of it. What if I wanted the opportunity to invest that money myself, earn a higher rate of return? You could do that in a variable life policy where you could earn a higher rate of return. What's nice about this cash value account is that we could do a lot of different things with it. So potentially we could utilize the cash value over time to cover our cost of insurance and stop paying premiums. So that could be an opportunity for us. We could also utilize the cash value over time. So let's say that we live 20, 25 years down the road. We don't have quite the need for death benefit, but we want to utilize this cash value for something. Again, those living benefits we talk about. So we could take distributions from the plan, maybe to use for emergency situations. Perhaps we want to pay off our mortgage. The first permanent insurance policy I got when I was younger was to cover my mortgage, and the plan was to utilize the cash value to pay off the mortgage early. And that plan is still actually in force right now. I also use college savings or this permanent insurance for a college savings plan for my kids. Instead of a 529 plan that we've heard about, which doesn't mean they're not good. They are good plans, but I use a life insurance cash value plan for my college savings for my kids. We could use it for a retirement supplement. There's really there's no reason we can't pull money out of these plans down the road. There are no restrictions as to what we could use the money for. So they're very good from a planning standpoint. They could do a lot of different things. So that gives you just a little overview of the different types of insurances that are out there, cover long-term care costs as well. So when we look at these different types, it's really just about determining what is the right type of plan for somebody once we have an idea of what they both are. And sometimes it's a blend of the two. The most common question that I get asked after going through this part is, well, which one is better, term or permanent? And there is no better in a vacuum, because no financial instrument is inherently good or bad. It's just which one is better for the situation. And again, it could be one or the other. It could be a combination thereof. So the second part is, once we know about the different types of coverages, well, how do we determine our need? And some of you have seen this before that may have worked with us or seen this on different presentations, is this plan we call Asset Map. And it really is designed to help us aggregate all of someone's information, take a look, and you could see the insurance planning opportunities up here. Is there something missing? We could at a quick glance take a look at it. But then we have a tool where we could forecast out what somebody needs and then what they have to cover that need. So just going through this very quickly to give you an idea of what it looks like, we will go through and, well, let me preface this by, if you go online, there are a lot of online sites that you could look at that have a very quick and dirty, how much life insurance do I need? And those calculators could help you get you a basic idea of what you might need. And you could look at a general rule of thumb, somewhere from 10 to 15 times your income. Annual income is what you need from an insurance benefit. And that could give you a starting point for it, but it is very helpful to go through a full planning analysis. So here's an idea in that planning analysis that Michelle mentioned early on, where every member of SANES has an opportunity to receive something like this. This is what it might look like. So we go through all of the different areas of what somebody would need if they were to pass away. And there are really two parts to this. One is the immediate needs. So what happens if someone passes away? What are all the bills that need to be paid? The expenses. So you've got final expenses. You've got some estate costs that you might have. Maybe we have a mortgage and some debt that we want to take care of. Different tax liabilities that we might have. If we have children, do we want to seed an education fund for our kids? So there are some things that we need to pay off initially in a lump sum if someone were to pass away. The second part of it is what about the income that's required? So this is the ongoing need, the long-term need. Well, if someone passes away, their income goes away. But it doesn't mean half the expenses go away or that percentage of the expenses go away in the household. So do we need some what we call transitional income? This could be one member of the household passes away and maybe the surviving member can't work for a certain period of time or has to take a step back. They might own a business practice and the income is going to be slow for a couple of months there. So is there a transitional income to help us get through that or get through the grieving process? What about if we have kids? We take a look at different time frames in someone's life. In this example, they have some children and they're 4 years until they are self-sufficient. So there's probably a higher income replacement need during that time than after the kids are gone. And what this does is it takes all of these future income needs and gives us a dollar amount that we would need today to fund that. So you could see they tend to get pretty big here, especially when we look at, well, what do we need for our full retirement for the rest of our lives? Important to note that when we look at from a SANES member standpoint, know that you all do have a death benefit tied through the New York State pension system. But if you do pass away in service, the pension goes away. You get that in-service death benefit, but your beneficiaries don't receive that monthly or annual income from your pension. So that's why the numbers get pretty big, because you're looking at your retirement forecasting and saying, well, we are dependent upon this pension and Social Security to pay a decent chunk of our retirement expenses. If that's gone, that need could be pretty big, and there's $1 million need right there. Looking at health insurance, premium payments, Medicare payments, and so forth. So somebody's need here, you could see, is $1.9 million. Seems like a lot of money. A lot of times people look at this and say, oh, no, it can't be. It can't be that much. Well, here's the math. This is how it actually gets calculated right there. But then we look at, well, what do we have? We could add in the Social Security. We could add in some different pensions that a surviving spouse would have, Social Security benefits, things of that nature. And then what about the assets? Do we have IRAs? Do we have 401ks and 403bs? Do we have some, again, an in-service death benefit through the state or wherever the money's going to come from that we have access to? How about some life insurance? Do we have any group insurance or individualized insurance in place? And that's going to tell us how much we have available to fill that need. So we needed 1.9 million. We got about 800 and something thousand. There's a deficit there. And what this asset map and target map plans will show us is, well, where are we? How much do we have versus how much do we need, and what's the gap there? So this particular individual is 46% funded for their insurance need. So then if we go back and say, well, all right, what type of impact is this going to have on the family? And this is really what it's all about. It's how is our family going to be impacted if this person were to pass away? And certainly, again, there is a deficit there. There's a shortfall depending upon if we had that money at a certain rate of return. Um, where's the money going to come from? So it's going to come from one or two places. It's either going to come from a life insurance benefit, or we're going to have the family perhaps struggle from a financial standpoint. If anyone has seen, and I'm sure everyone has gone through this, friend, family member, acquaintance, someone in the neighborhood passes away unexpectedly, and there's a GoFundMe page that gets launched. It's great when the community comes together to support families, but you think about, is your plan for a kind family member or neighbor to set up a GoFundMe page to cover this deficit? Or maybe should we take some steps to cover that deficit through an insurance plan? So that's an idea of the type of analysis that we would go through when somebody is looking at an insurance analysis. And that's, of course, the morbid part, the death benefit part. But take a look at, well, aside from protecting our families, what else can insurance do? What are some of those living benefits that we could look at? One of the opportunities is in leaving a legacy to our children and grandchildren. There's this never money concept where many times we talked with people, and people that, like Samies members that have pensions and Social Security, and they say, well, I've got this 403B, or we have this IRA, and we're never going to spend the money. We're going to leave it onto our kids or our grandkids. And that's great. It's great to try and create that generational wealth and pass assets on to the next generation. I will tell you, though, that retirement plans and investments like 401ks and 403bs and IRAs are a very, very inefficient way to transfer money to the next generation. Life insurance is a much better planning tool to leave to the next generation. So that is an opportunity to take a look at how we're leaving that money and providing those gifts, perhaps. We talked before when we were looking at the different types of insurances. Perhaps we're looking for a retirement supplement. And when we do our tax classes, we talk about the fact that your pensions, your Social Security, your pre-tax 403bs, your IRAs, many of those or all of those income sources are taxable in retirement time. What if we want an after-tax bucket to spend in retirement? We could use the cash value accumulation to provide that. We could use it to help cover long-term care needs, another planning tool that we could use life insurance for. So again, we're living, we haven't passed away, but it's a living benefit that we could use our life insurance for. There's actually a way to use a life insurance death benefit to prepay that death benefit for long-term care costs if that plan is structured properly. And then we talk about this a lot, and all of you do attend those workshops where we talk about our pension. We talk about how do we maximize our pension benefit. Instead of taking a reduction through New York State, can we take the maximum option and have enough assets to leave behind to our beneficiaries, to our surviving spouse or significant other if we do pass away? So we talk about it ad nauseum. I know some of you are tired of hearing about it, but how many of you have taken action and purchased a life insurance plan so that you can take the maximum pension benefit when you do retire? Something that we should all consider doing for ourselves, or at least looking at the opportunity, I should say, and if it's right for you. There are a lot of different things that the insurance plans could do for us that we don't always think about. We always think about the death benefit, but it's important to think about the living benefits and some of the other planning opportunities around it. So what should we do from a next step standpoint? Number one is, if you haven't done so in a little bit, assess your situation. Take a look at the plans that you have. So there are really two components of it. There is, do we have enough coverage in case something were to happen to us? And number two, do we have the right type of coverage. So for example, if you have an insurance policy that was taken out, say 15, 20 years ago, and it's interest rate based, meaning it's one of those whole life or universal life policies, and your cash value accumulation was projected at a 7% interest rate. Well, what's happened? Interest rates have come down, so the policy projections might not hold true. When's the last time we've done a financial checkup on those plans? Is it the right type of plan moving forward? It might have been the right type of plan when you got it at first, which is great, but is it still the right type of plan moving forward? Take a look at that. Take a look at, if all we have is term insurance, is that the right fit? Do we need to sprinkle in some permanent coverage? So it's about having the right amount of coverage and having the right type of coverage as well. These are things that an insurance professional could take a look at. So I got ahead of myself a little bit, but that's number 2. Review the current insurance policies. Insurance policies are really no different than assets, no different than retirement plans. We all want to look at our retirement plans on a regular basis and see what they're doing. We do want to do the same thing with our insurance plans as well. And then talk to someone. This is very difficult to do on our own if we don't have access to the information, access to different companies and their plans. There are so many different types of insurance plans out there, different riders out there. Some will work for us, some won't. But let's make sure we're working with someone knowledgeable to help. The online and some of the radio commercials that we hear, call so and so, you could get X amount of coverage for 18 cents a day. Is that the strongest, best plan for you? Not really sure. So work with an advisor to help out. And then really important is, once you do this, educate your families. Tell them what you've done. Tell them what you have and why you did it. Go through what you want to see happen with that death benefit. If you are leaving money to an individual and you'd like them to invest it a certain way or spend it a certain way, or maybe give some money to a charitable organization or help out individuals in the community, have those conversations and talk to people about it. It should be something that is helpful and celebrated, and not something that is a burden for folks. Because just like sometimes this might seem strange, not having insurance and not having coverage is certainly a burden from an emotional and financial standpoint. But sometimes having all this money is a burden too. And what do we do with it? And how are we supposed to allocate this to our family members? There's a joke I saw where somebody said, I wanted to do a family tree analysis, this DNA analysis, to see who my extended families are, people I don't know about that I'm related to. And I said I couldn't afford the test to do it, so I just posted online that I won the lottery. And then, of course, the joke is that all of a sudden you meet all the family you never know you had, so to speak, because now they think you have money. Well, don't think the same thing doesn't happen when someone inherits some life insurance money and all of a sudden people come out of the woodworks. And take that burden away too, and coach the individuals along while you're living, so that you have an idea and they have an idea of what your real desires are. So hopefully that was helpful. I wanted to leave some time for questions right here. So I'm going to pop back over here, Michelle, and see if there are any questions. There are a couple things in the chat here. Well, just from you.
So that was my welcome. I'm
Yeah.
not seeing any particular questions now, so we'll give it a minute here, and feel free to type it into the Q&A or the chat.
Now I'm just going to pop my phone number in here. Geez, I apologize. I mean to do it on a slide, but I didn't put that in. But I'll put in my phone number and email address so that if people have any specific questions, I know that this is something where sometimes we have very specific personal questions that we want answered, and we don't want to ask that in a setting like this. So we certainly get that. If you have any questions, you can feel free to give me a call or shoot an email over.
Okay, let's see. All right, well, and also before we leave, if you go to also saneys.org, under resources, you'll see a pull down for equitable services. So it'll give you a description of the different services and also a link. Oh, we do have one question from Michelle. I had heard that sometimes a team can be converted a term can be converted into a permanent. Is this something that is offered?
Yep, great question, Michelle. So it will depend on the company that you have that term insurance through. So there are companies that offer both term and permanent insurance plans, and some companies only offer term plans. So if it's a company that has term and permanent insurance together, then yes, you can convert that term. So this would be an example where somebody needs coverage, but they don't have the cash disposable on hand to afford a permanent policy. So they might buy a term plan just to get the insurance in force to protect their insurability, because we could convert without having to apply again. So we lock in our health rating when we're younger and healthier, and then we can convert that to a permanent plan later on. So I mentioned that the ones online, the ones that you hear on the radio, the real cheap, it's 18 cents a day for term insurance. Chances are those types of plans are not going to be convertible. But if you work with a company that has both types of plans in place, then yes, you're able to convert those plans. And some companies have rules that are a little more stringent, some are pretty wide open. So that's a good question to ask if you are looking at doing term insurance today and potentially looking at a permanent solution later. Thanks for that question.
Okay. And a couple of thank yous, very helpful from Andy. And that also reminds me before we leave, if there's no other questions, Greg and his team are always present at the Sandy's Annual Conference, and that'll be again this year. So if you haven't already signed up, join us at the Sagamore in October, October 23rd, and you can meet the team there and ask more questions.
Certainly.
All right, we'll give it one
And I'll hang
more.
on for a few minutes if people need to hop off. We're within our half hour, but if anyone has any other questions or thoughts, I'm more than willing to stay on for a few minutes.
Okay, we'll give it a minute, give people time to type. All right, Greg, that might be it for the day.
That might be it. Well, hopefully the information was helpful to all of you. Hopefully you take action on it. The spoiler alert here at the end is that no one lives forever. So we all need this. We all need to talk about it. And hopefully this creates a little bit of urgency to have that conversation.
Okay. All right. So again, feel free to follow up with Greg and his colleagues, and we hope to see you all at the conference. And have a great weekend, everybody. Thanks for coming. Bye-bye.